President Trump's decision last night to strike Iran could have massive economic consequences. Already this morning, the Iranian parliament has voted to close the Strait of Hormuz, a vital passage in which almost a quarter of the world's oil transits through. But oil isn't just fuel, it drives economic activity, spikes inflation, consumer spending, hikes producer prices. History shows that almost always oil price spikes precede a recession. If oil prices soar, economic growth could stall. Worse, with interest rates rising and nominal GDP falling, our massive debt could trigger a huge crisis. So clearly, last night there were the three strikes on the Iranian nuclear program. We have addressed, in another video, which I will link. I think is super important if you haven't watched that one already. A channel in which oil prices drive treasury yields higher. And this is the channel where creditor nations of the U.S. historically have, been countries like Japan and China who have run massive current account surpluses. They've accumulated positive net international investment position due to those current account surpluses. Well, their savings, their national savings, largely has been in U.S. Treasuries. So, as they rely on foreign energy, they do not have enough domestic energy production. They rely on importing it. As the cost of that energy rises, they are driven into a current account deficit. Well, we know that they have these huge piles of savings in U.S. Treasury bonds. One of the ways they fund that current account deficit is by selling Treasury bonds, drives yields higher. We covered that channel in a prior video. This one, though, I want to look at the effect that it could have on triggering a debt crisis, fiscal crisis, sovereign debt issue, but also the effect that it has on the real economy, inflation, consumer spending, and these sorts of things. So here is the Newsweek article. This comes after the strikes last night by President Trump in Iran. Iranian parliament votes to close the Strait of Hormuz after U.S. attacks. So the Strait of Hormuz, if you're not familiar, is this area right here, this narrow passageway in between. This is Iran and then the Emirate countries. A huge amount of oil transits through the Persian Gulf there, and then ultimately through that Strait of Hormuz, between 20 and 25%, depending on the year. So a closure of the strait could drive oil prices sharply higher. Now, remember, major banks have said that. I think JP Morgan and Goldman Sachs have both said that oil could move above 90. I think JP Morgan even said $120 a barrel if there was a closure of the Strait of Hormuz. So what effect would that have? Well, a couple things. So here in white, we have the price of oil in logarithmic form. And what I want to illustrate is that when the price of oil spikes, as we can see here in white, the price of oil here in 73 moved from $4 a barrel, all the way up to $10 a barrel. So more than a doubling. You can see these red vertical shadings. These are NBER defined recessions. The NBER is the National Bureau of Economic Research. They are the official declarer of a recession. What I want to show is that, every one of these recessions, except for the double dip in the early 80s, where we kind of, arguably never got out of the recession, other than that one double dip recession in the early 80s, every time the price of oil spikes meaningfully higher, remember this is a logarithmic chart, so a rise like this is very, very dramatic, right? Logarithmic charts adjust for exponentials. Here, in 78 leading into 1980 recession, we can see oil move from $14.85 a barrel all the way up to about $40 per barrel, right? So these are, anytime you see a spike, that is a large move because this is a logarithmic chart. Well, it leads to a recession. And this is true even in the modern economy. You can look, even the dot-com bubble was preceded by a massive oil price spike where oil went from $12 a barrel all the way to a peak of $34 a barrel. We see this huge spike in 2000, leading into 2008, and then in 2022, there was arguably a recession, but political decisions were made not to actually call it a recession. But in 2022, with that spike, it did cause 2 quarters of negative GDP growth. For whatever reason, they were not defined as a recession. Unemployment stayed relatively low, but we'll leave that as for another video. The point here is that oil prices spike, and it is always followed by a recession. The other effect that it has is on real GDP. So I'm going to take off inflation here, and I'm going to take off nominal growth here in blue. So hopefully this is easier to see. But as the price of oil spikes, you can see what happens to green, which is real inflation adjusted growth. Well, it falls notably. Remember, the red shaded areas represent recessions. Recessions, generally speaking, are 2 consecutive quarters of negative GDP. And we can see that every price spike in oil causes real GDP to fall off rather sharply, rather quickly, including all of these prior recessions going back 35 years. So here's a paper. I'll link to it in the description. This talks about the causes of the oil shock in 2008. And we won't go into all of them or go into this in detail. If you want to read it, it's a good paper. It's a little long, but it's good at painting the picture here. I'm not trying to argue that 2008 was caused by the oil price spike. I'm trying to argue what they are trying to argue, which is it was a huge driver in the GFC, in the Great Financial Crisis, in that kind of economic catastrophe. And we will look at one of the causes of the oil price spike. But needless to say, that they come to the same conclusion, which I'm trying to make, which is they made a material contribution to the negative growth that we saw in 2008, to the kind of the degree to which the GFC was negative for the economy, for the global economy. So here is one channel in terms of the effect that oil price spikes have. So in white, we have what's called a credit spread. A credit spread is the difference, the spread between 2 different interest rates. In this case, it's the difference between the interest rate on a corporate bond, right? If Apple and Microsoft, they issue bonds no different than the Treasury, right? You're taking the interest rate on that corporate bond and you're subtracting the quote unquote risk-free rate of a US Treasury bond. I understand treasuries are not actually risk-free, but in general, they are assumed to be risk-free. That is how a credit spread works. So as this white line moves higher, what it is indicating is higher risk. And you can get different credit spreads. You can look at very high-rated corporate bonds, all the way down to junk corporate bonds. You can compare. There's a multitude of ways to kind of pick the 2 sides. But in general, what it's trying to illustrate is the spread, the variance between 2 interest rates. As it moves higher, that is indicating higher risk. Whether you're measuring a very high-rated corporate bond to a very low-rated junk bond, right? If that credit spread widens, that indicates risk. But you can also, calculate it by looking at a corporate bond interest rate relative to the U.S. Treasury interest rate. And, as that gap widens, it is indicating stress or economic uncertainty or fear in credit markets, in the overall economy. And what I want to show is how tightly correlated credit spreads are to oil. And we can see that, the price of oil here, WTI, reached a peak in 2008. And credit spreads had already been moving sharply higher with oil. You can see how tightly correlated this are, how almost real time credit spreads were moving higher as oil was moving sharply higher. So what credit spreads are indicating is kind of more on the financial side, but it's an indication of real kind of actual economic risk or actual economic uncertainty. And the same is true here, leading into the dot-com bubble. So why is that? So here is PPI. This is one way to measure inflation. This is the producer price index. And then in white is WTI oil price in logarithmic form. And what I want to show is, again, the tight correlation between PPI. Again, this is the cost for the producer of a good to make a thing, a widget, and the price of oil. And we can see, again, a very, very tight correlation almost in real time. As oil moves higher, the producer price index, the inflation rate for producers, goes higher. Now, PPI leads You see higher inflation in PPI generally a couple months before you see it in CPI. So there is some lag to CPI, which is why I'm showing PPI. But the point here is that higher oil prices drive inflation higher. Well, if you think about what it takes to make a widget in China, that energy, right? China doesn't have enough domestic energy; they need to import energy. Okay, so the price of that energy goes up. The cost for that factory to make that widget goes up. The workers might be demanding higher wages. I understand it's China, but just go with it. Higher wages, right? Because it's taking more money to fill up their gas tank to get to work. So they're demanding higher wages, right? It can drive even wage price inflation. Well, then the widget gets made with energy, with people that need to be compensated for their energy usage. Then it needs to get shipped to America. Well, how is it shipped? It's shipped on a tanker or a cargo ship, right, which runs on huge amounts of fossil fuels. Then it gets to to a port and needs to be distributed to a right. Energy is critical. It is the foundation for everything in the modern day world. So as energy prices move higher, especially if it happens very rapidly, we can see the effect that that has on producer prices. And remember, producer prices lead consumer price inflation. And so hopefully that correlation here is clear between oil and producer price index. Now, what I'm going to do is I'm going to overlay consumer spending. I'm going to take oil off and overlay consumer spending on PPI. Consumer spending I inverted to hopefully illustrate the point a little more clearly. What this means, as the yellow line moves up, consumer spending is slowing. The growth rate of consumer spending is slowing down or even going negative. And you can see that on this far right scale. And again, look at the tight correlation. As the producer price index rises, consumer spending slows. As the producer price index falls, consumer spending rises, right? So hopefully this correlation is clear between consumer spending and PPI, which is then correlated to oil, right? PPI is dependent on oil, and consumer spending is dependent on PPI. I think that the real issue here is the starting point that the current American economy is in. So, for example, consumer spending is a huge portion of the American economy. It's like 65% of GDP is consumer spending. Well, that already kind of sounds strange or stretched, you could say. Well, then you start to look at a distribution of who is doing that consumer spending. The top 10%, we just hit a record where the top 10% of income earners now account for 50% of all that consumer spending. So this bifurcated K-shaped economy we've created is utterly reliant on the wealthiest to continue spending, right? If you are not in the top 10%, the reality is that economically, at least in the kind of national aggregate data, the data doesn't really care if you can't afford to live, if you can't afford to spend, because again, it's the top 10% that are propping everything up. This is a record. This has never been reached. That level 50% has never been reached before. Just one illustration of kind of the insane starting point that we find ourselves in. Well, okay, if consumer spending, which is the vast majority of our GDP, is dependent on the top 10%, well, why are those people in the top 10%? Well, they have financial assets, right? We've created this K-shaped economy where it's everyone who holds financial assets, everyone who doesn't. Especially true 2019 and moving forward since 2019, including houses, which shouldn't be a financial asset, but unfortunately have become a financial asset. So we have this K-shaped economy that is more and more reliant on the upper quintile income earners to spend to prop the kind of aggregate overall economy up. Well, again, why are they in the upper wealth brackets? Is because they own financial assets. Well, what happens to financial assets when oil prices spike? Well, they fall. Here we see the S&P 500, and we can see that the S&P 500 peaked here in October of 07, and oil was $86 a barrel. As oil moved, the S&P did not set a new high all the way, until 2013. So from that period on, this entire rise in the oil, this final kind of blow off top in oil price, the S&P was falling. So, the S&P led, I guess is what I'm trying to say, was already kind of topping out here during this period of time. It was kind of doing that double top formation. It was already kind of losing steam. And then it started to roll over long before the peak in the oil price. And the same is true. You can look at other periods of time of sharp equity market declines. Here, for example, in 2022, you can see that the S&P 500 peaked in December 21, January 22, and look at what the price of oil was, right? During that peak, the price of oil was only at $82 and it would go on to hit $115. So again, the equity market rolls over first. Well, given that the we are more and more reliant on the top 10% to prop up consumer spending, propping up the overall economy, the top 10% have their wealth in financial assets. Financial assets lead and might show weakness. Well, what does that do to the wealth effect? People talk about the wealth effect, right? The wealthy see a green number in their portfolio. This S&P 500 just only goes up. Okay, that's great. They see a big number in their portfolio. They feel confident. They go out and spend. Well, what is the opposite of that? What about when they start seeing a red number in their equity, in their Robinhood account? They spend less, right? So that link hopefully is clear. And not only that kind of hyper financialized link to the real economy, but also you get into a situation where the government has become reliant on the S&P and financial assets going up forever to fuel capital gains tax. So capital gains tax revenue is a huge driver of overall revenue for the government. So as the equity market goes higher, they make more money. The government makes more money, right? Capital gains tax. People are realizing gains. It's a bull market. They're realizing more gains. Well, those gains get taxed. That tax goes to the government. I think I did a video on this, why the stock market cannot be allowed to decline. Maybe not. Maybe if you'd like to see that, leave a comment. I think I did. But you have kind of multiple incentive layers here where the wealthy want financial assets to always go up because they feel wealthier, fueling confidence, right? Spending, which is driving overall economic activity, right? About 65% of the overall GDP is coming from consumer spending. Of that 65%, half of it is coming from the top 10% who have a lot of their wealth in financial assets. As financial assets roll over, they feel less confident, spend less. That drags on GDP quite significantly. Well, not only that, but for the government, if financial assets start to show weakness, well, capital gains tax revenue goes down, and that is a huge driver of their overall revenue. And so you get into a situation where even before the recession actually hits, you have revenues falling and expenditures going up, right? If we're going to be in a war, I guess now, we got to fund that war. It takes money. So, right, the deficit is already increasing and widening, right? Revenues and expenditures going up, revenues down. That's widening the deficit. Well, the problem is the starting point is such an utterly insane 6.5% of GDP deficit that on average in a recession, the deficit widens by 600 to 800 basis points. That would take us to a 15, 16, 17% budget deficit in short order. And I believe long-term rates will go up in that environment for the first time, at least in modern history, at least for the U.S. There's a common emerging market phenomenon where in a recession, long-term yields don't go down like they have historically in the U.S., right? People don't go buy long-term bonds. They short them. They sell them. Yields go higher, drives the deficit wider, right? Because interest expense is now higher. You got to fund that by issuing more debt, driving the deficit higher. Higher bond supply being pushed at constant demand equals higher rates. You get into a cycle. And so what I want to show with that particular phenomenon. Oh, before I get there, the authors had mentioned, I said I would point to one of I would illustrate one of their causes for the oil price spike. They mentioned negative real rates and the Fed and their role in creating a commodity, speculative bubble. And sure enough, I looked at it and it's true. So here in October of 07, the 2-year started to yield negative real rates, meaning inflation was higher than the yield you were getting on the 2-year treasury. That's a negative real rate. And because of that, right, we can see the Fed funds was getting cut lower. Because of that, it drove speculation, right? Wall Street needs to make money. If they're losing money from buying treasuries, they're definitely not going to buy treasuries. They need to find something to make money. One of the things that they did was speculate in commodities like oil. And sure enough, that caused kind of this final leg higher, the blow off top in oil. But going back to the point that I was making about this debt crisis, this fiscal crisis, this sovereign debt crisis, driven by higher rates and falling higher deficit, higher rates. Here is nominal growth in white, and then a couple interest rates. So we have in yellow the 2-year, in orange the 5-year, in red the 10-year, and in green the 30-year. What I want to point out is what happens in recessions. So nominal growth is falling, right? The economy is going into a recession. Growth is falling, even maybe going negative. Well, look at how it drops below the cost on the debt. And this is characteristic of recessions, right? We can see it here in '08, and clearly, higher the longer term maturities, this happens sooner, right? They have a higher rate, so that happens sooner. But in general, what you get is nominal growth below the cost of the debt. We have been pointing this out for many months now, but the trend here over the past 2.5 years has been rising rates, rising interest cost, the cost of the debt, rising interest expense, rising interest rates, rising bond yields, and falling nominal growth. Some of these have already started to cross. The 30-year started to cross already. The 10-year is basically at nominal growth currently. So you can't really afford higher rates. We established PPI is going to be spiking, right? I will take off consumer spending and put back on PPI and oil. If producer price index is spiking higher, moving sharply higher because oil is driving production costs up, you think the Fed is going to be cutting rates? No, of course not. Not especially not given the kind of how badly they fumbled 21 and 22, calling inflation transitory, right? All those issues. Of course, they're not going to repeat the same mistake. Not at least not so soon after that massive mistake, which they were criticized widely for. So you're talking about a situation where the Fed will not be cutting rates. Maybe I'm not saying they'll be hiking per se, but they will not be cutting. Given that, you would have PPI moving higher, and eventually, a couple months later, you'd have CPI moving higher. There's no way that they'd be cutting rates. So you're talking about a situation where maybe their short-term rate is staying flat, right? They're not cutting, they're not hiking. Okay. But if rates start to kind of nudge up because inflation is moving higher, and it would happen sharply and quickly, this cross could get dramatic. Like I said, the 30-year has already crossed. The 10-year is basically right there at nominal growth. The shorter and the belly of the curve, 2-year, 1-year, 2-year, 5-year, are slightly below nominal growth, but not by much. And so again, if inflation is driving yields higher, right? Because no one in the bond market wants to have that negative real return that they were getting right here. No one wants to buy a bond where inflation is going to be higher than the interest rate on the bond. I don't see a situation where the Fed could be cutting. So here is what would happen. So here in blue is debt to GDP. Here in white is the 10-year treasury yield minus nominal growth, which is what this white line, what we're looking at there. And so what I want to illustrate, anytime the white line is below this dotted red line, what that means is the cost of our debt is below nominal growth. And sure enough, we can see that eases the debt burden for the government. Well, anytime it moves higher above nominal growth, that makes the debt burden worse, right? Debt to GDP goes up. The debt burden is harder for the government to manage. Here, I should have a little red box, but this was the dot-com recession. We can see that at the peak, the 10-year treasury was 4% higher than nominal growth at the worst peak of it. And sure enough, we can see debt to GDP kind of nudged up. I think that's why I didn't put a box. It wasn't. I'm trying to paint the kind of general trend here. But you see this during recessions, right? Because nominal growth is falling and interest rates don't fall the interest rates don't go negative, right? If nominal GDP is -2%, like it was in the heart of the GFC, you don't see a -2% treasury yield. Therefore, the cost of the debt is higher, even if the interest rate on the debt is 0 or 10 basis points. If growth is negative 200 basis points, you get this white line moving above, moving positive. You get an increase in the debt burden. This, this positive, this growth under the cost of the debt. This is a nightmare, given the fact that we have 120% debt to GDP, 125% debt to GDP, 20% of tax receipts going to interest. Mandatory spending is 100% of tax receipts. We're starting from an utterly insane 6.5% budget deficit that has been deeply embedded in the economy for the past 4 years, despite full employment and no major war, up until now at least. The fiscal health is already very, very poor. And we've been noting this cross here. The 10-year treasury, again, is right at nominal growth. And this chart looks like it's moving higher. This looks like it's in the process of moving above nominal growth. Well, that makes the debt burden worse for the government. And when the debt burden is already so bad, hopefully you can see how this can become an issue. So here's the yield curve. We've addressed the yield curve this way of visualizing it before, but what I wanted to show was here's 2008, and you can see the 30-year Treasury was significantly higher over the shorter durations, like I think the yellow is the 3-month. You can see how wide this range was. Well, what happened during 2008? Or leading into 2008, bond yields were all relatively right at the same rate. And then what happened? Then you had a situation where rates started to fall, right? The Fed was cutting their overnight rate here in white. That shows the overnight Fed funds rate. They were cutting that rate, so interest rates were falling. But look at how quickly the short-term interest rates were falling, like the 3-month, the 6-month. I think it's on this chart. Yeah, it's the 1 year in orange and the 3-month in yellow. Look at how quickly those fell. So what this does is called a steepener. So the yield curve gets steeper because the long-term yield, the difference, you are getting a much higher long-term yield than you are a short-term yield. That is called a steepening of the yield curve, right? You can see the gap between the purple and the yellow getting bigger. That's called a steepener. But it's happening as interest rates are falling, or put another way, bond prices are going up. Well, there's another kind of steepener, which is a bear steepener, and it's where interest rates are rising, but long-term rates are just rising faster. And that is arguably what we've been in since the Fed started to cut in August of 2024 under the last administration. You can see here in purple, the 30-year has been moving higher. Blue is the 10-year. That has moved higher. And green is the 5-year. And even though it's kind of moved slightly lower over the past couple months, since the Fed started to cut and we really kind of entered a new phase, I mark this September of 24 as the start of kind of a new phase. Since that cutting cycle was engaged, we have seen a bear steepener. It might not be super dramatic yet, but we have seen a bear steepener. This is bearish for bonds. And if long-term rates go higher because creditor nations are being pushed in a current account deficit, forcing selling, driving rates higher, and then you add in the domestic issues where people are saying, higher producer price index inflation, and eventually a month or two later, higher consumer price inflation. So rates are rising here. Again, we established the Fed's not going to be cutting rates in that environment. This gets very, very ugly, in my opinion, very, very quickly. This is why I have phrased a recession as a margin call on the debt. If you've ever traded on margin, a margin call is where you are borrowing money from the brokerage. You're investing that money hoping to make, a leveraged return. Well, if that trade starts going against you, the brokerage is at a certain point going to go, look, we're not losing any money on this. You need to come up, you need to either close your position or, right, that's a margin call. So For the US government, I've argued that a recession is basically a margin call on the debt because by definition, in a recession, the deficit widens by 6 to 800 basis points. Well, when that happens, given how insane the starting point already is, things get very ugly very quickly. And if oil is spiking higher, PPI is spiking higher, inflation is spiking higher, you're going to see bond yields move higher, not only because of that, but also because of the creditor nations selling because they're in current account deficit. That channel, which again, I will link at the end of this video. So it's a very ugly scenario in which the Fed can't cut the short term rates. They can't cut the short term rates. Longer term rates are moving higher, driving the deficit higher, right? Driving interest expense higher as interest expense is funded by issuing, the deficit increasing. Now the deficit is increasing to issue more debt to pay the interest due to the higher rates. Well, that higher deficit means more bond supply into constant demand. Well, that means higher rates, right? You get into a spiral that is very difficult to get out of. So, all this to say that, I don't know if this is actually going to happen. I mean, they voted to make it to make it happen. But if it does, and if the major banks are right, and oil goes to, even if oil just moves 50, 60% higher, even that alone could have significant consequences on the financialized economy, on the real economy, and on the rest of the world that have been the ones that have bought and accumulated huge amounts of US treasuries. Um, all these things coming together, and you throw into the mix, if we're, I guess, in a war, again, another one, we got to fund that war. Well, how are we going to fund it? We don't make, we're already running a $2 trillion deficit. How are we going to fund it? Well, we're going to drive the deficit even higher. Um, and we might be faced with like also a recession on top. It gets very ugly very quickly. So my hope is that that cooler heads prevail, and that some real leadership starts to be start getting shown by global leaders, because things I'm just speaking economically, from the economic side, things do not look good if this continues to kind of ratchet higher in terms of escalation. And so anyways, I would highly recommend that other video. I will link to it right now. Hopefully that was helpful, and I guess we'll just cross our fingers, keep watching, and try to update with any notable updates that we see. Talk to you in the next one.